What if I told you that the richest bank in America committed fraud for 8 consecutive years, stole billions of dollars from ordinary investors, got caught red-handed by federal authorities, and then walked away with nothing more than a slap on the wrist? You'd probably think I'm spinning conspiracy theories, but here's the terrifying truth. This isn't speculation. This isn't theory. This is admitted fact, documented in federal court, confirmed by the Department of Justice, and completely ignored by mainstream media. Right now, as you're watching this video, the same system that allowed this theft is still operating. The same banks are still trading, the same algorithms are still running. And millions of people have no idea they're playing a game that was rigged from the very beginning. What you're about to discover will fundamentally change how you see money, markets, and the invisible hands that control both. Before we dive deep into one of the biggest financial crimes of the century, I need you to do something critical right now. Hit that subscribe button and turn on notifications for Dark Economy. Why right now? Because channels that expose these truths don't get promoted by algorithms. We get buried. And if you don't subscribe now, YouTube's system will make sure you never see content like this again. So click subscribe, ring that bell, and let's expose how the game is really played. I promise you, by the end of this video, you'll understand why ordinary investors keep losing while the system keeps winning. Let's start with a question that will set the stage for everything. Imagine you discovered a hidden lever inside the global financial system. Every time you pull this lever, money appears in your account. Not from hard work, not from smart analysis, just pure profit, extracted from a system you secretly control. You pull it once, $10 million appears. You pull it again, another 10 million. Day after day, month after month, year after year. No consequences, no oversight, no punishment. Now imagine, this lever isn't hidden in some dark corner of the internet. It's inside the largest bank in America, operated by traders in expensive suits, approved by management, and protected by lawyers who know exactly what's happening. This lever exists. It was used for 8 straight years, and when authorities finally caught them, the punishment was so pathetic, it might as well have been permission to continue. In September 2020, the United States Department of Justice issued a press release that should have been front-page news on every financial website in the world, but it barely made a ripple. The statement revealed that JPMorgan Chase, a bank with over $3 trillion in assets, had officially admitted to manipulating the precious metals markets. Not just gold, not just for a few months during a crisis, but gold and silver systematically for 8 full years between 2009 and 2016. 8 years. Let that number sink in. That's not a mistake. That's not one bad trader going rogue. That's an institutional strategy. That's a culture of fraud built into the daily operations of the most powerful bank in the United States. We're talking about thousands of illegal trades, executed by multiple traders, supervised by managers, generating billions in illegal profits, while everyday investors on the other side lost their savings. The Justice Department didn't use soft language. They didn't call it an error or a misjudgment. They used the word fraud. The FBI, in their own statements, said JPMorgan plotted and schemed to manipulate precious metals markets. This was premeditated. This was organized. This was criminal. So what was the penalty for 8 years of admitted market manipulation? JPMorgan was fined $920 million. At first glance, that sounds like justice. That sounds massive. But let me give you context that changes everything. During those same 8 years, JPMorgan's precious metals trading desk generated billions upon billions in revenue. Some analysts estimate the real profits from these activities exceeded $10 billion. So here's the math. If you steal $10 billion and pay back less than $1 billion, is that a punishment or a business expense? If a criminal robs a bank, takes $1 million, gets caught, and the judge says, pay back $200,000 and you're free to go, would you call that justice? That's exactly what happened here, except with billions instead of millions. But the story gets worse, much worse, because understanding how they did it reveals just how broken the system really is. The technique JPMorgan admitted to using is called spoofing. The name sounds almost harmless, like a prank, but it's anything but harmless. Spoofing is illegal under the Dodd-Frank Act. It's banned worldwide. And yet, it worked perfectly for nearly a decade. Here's how every market works. There's an order book. On one side, you have buyers willing to pay a certain price. On the other side, you have sellers willing to accept a certain price. When these two sides meet, a trade happens, and that becomes the market price. The system is built on the assumption that every order in that book represents real intention, real buyers, real sellers, real supply, and real demand. But what happens when the supply is fake? What happens when massive orders appear in the book with zero intention of ever being filled? That's spoofing. And that's exactly what JPMorgan's algorithms did, thousands upon thousands of times. Here's the exact playbooks. JPMorgan's trading system would place enormous sell orders into the silver market. We're talking about thousands of contracts representing millions of ounces of silver on paper. These orders would appear in the market like a giant wall of supply. Other traders, scanning the order books, would see this massive sell pressure and panic. They'd think a big institution was dumping silver. They'd assume the price was about to crash. So what did they do? They canceled their buy orders. They sold their positions early. They moved their stop losses. Some traders even went short, betting the price would fall. All because of orders that were never real. The moment the price dropped from this artificial panic, JPMorgan would quietly cancel those fake sell orders and then buy real contracts at the now lower price. They didn't predict the market would fall. They forced it to fall. They created the panic, profited from the chaos, and repeated the process. This happened tens of thousands of times, not once, not twice, tens of thousands of documented instances over 8 years. Every single time, real traders on the other side lost money. Pension funds, retail investors, small mining companies hedging their production, they were all trading against ghosts, and they never knew it. If you're starting to understand how deep this goes, leave a comment right now. Tell me what you're thinking. And if this information is valuable to you, share this video with someone who still believes markets operate fairly. Because the truth is, most people have no idea this is how the game is played. Your comment and share help this message reach more people who need to hear it. Now, here's the question that should be keeping regulators awake at night. If JPMorgan was caught, investigated, and admitted to fraud, why is the bank still operating? Why wasn't their trading license revoked? Why weren't executives criminally charged? Why didn't anyone go to jail? The answer reveals something even more disturbing than the crime itself. JPMorgan is considered too big to jail. Prosecuting a bank of that size, according to government officials, could destabilize the entire global financial system. If JPMorgan faced real consequences, if they were shut down or severely restricted, it could trigger a cascade of panic across credit markets, freeze lending, and potentially cause an economic crisis. So instead of justice, the government created something called a deferred prosecution agreement. In plain English, it works like this. JPMorgan pays a fine, admits they did wrong, promises to behave better in the future, and then continues business exactly as usual. No criminal charges against individuals. No shutdown, no revocation of privileges, just a financial payment and a promise. And here's the kicker. That $920 million fine wasn't even paid by the people who committed the fraud. It was paid by shareholders. The executives who designed the strategy kept their bonuses. The traders who executed thousands of illegal trades kept their jobs. The managers who supervised this operation faced no personal consequences. This transforms punishment into permission. It sends a crystal clear message to every major financial institution. You can cheat, you can break the law, you can commit fraud. Just make sure you're big enough that shutting you down would cause chaos, and make sure you save enough profit to pay the eventual fine. It's not a deterrent, it's a cost of doing business. But there's an even deeper reason why the government looked the other way. And understanding this reason unlocks a secret about how modern economies actually function. Gold and silver are not just shiny metals. They're not just commodities. They're report cards on the value of paper currency. Throughout history, when confidence in a government or its currency falls, people flee to precious metals. When gold rises dramatically, it signals that people are losing faith in the dollar. When silver surges, it means investors are hedging against inflation and currency debasement. In other words, rising precious metal prices are embarrassing to governments and central banks. They reveal underlying problems in the monetary system. For this reason, governments have always had an incentive to suppress gold and silver prices. This isn't conspiracy theory. This is documented history. In the 1960s, the London Gold Pool was a secret arrangement between central banks to manipulate gold prices and protect currency values. It's admitted fact. They sold physical gold to keep prices artificially low until the scheme collapsed in 1968. Today, the strategy is more sophisticated. Instead of governments openly selling gold and silver, they rely on major banks to manage prices indirectly. These banks, called bullion banks, act as proxies. They flood the market with paper contracts. They absorb physical demand by offering synthetic exposure through derivatives. They cap price rallies before they gain momentum. And when these banks cross legal lines, when they commit fraud to maintain control, they're quietly forgiven with fines that don't even dent their profits. JPMorgan isn't just any bank in the precious metals world. They are the custodian of the largest silver ETF on the planet. They control the physical vault. They control the paper instruments. They see every order flow. They know who's buying, who's selling, and how much physical metal is actually moving. This creates the perfect environment for manipulation because they have complete information asymmetry. They see the entire board while everyone else is playing blind. And for years, this system worked flawlessly. But then something changed, something the banks didn't fully anticipate. Industrial demand for silver began to explode. Solar panels became mainstream, requiring massive amounts of silver. Electric vehicles, packed with electronics, consumed unprecedented quantities. 5G infrastructure, medical devices, advanced semiconductors. Silver wasn't just an investment anymore. It became a critical industrial necessity. At the same time, a growing number of investors stopped playing the paper game. They stopped buying ETFs and futures contracts. They started demanding physical delivery, real metal, bars and coins they could hold, and that's where the entire system started to crack. For decades, banks sold far more silver contracts than they physically owned. This is legal under the fractional reserve system. As long as most contract holders settle in cash and never ask for delivery, the system functions. But when delivery requests increase, when people start demanding the actual metal instead of paper promises, vaults begin to drain. Banks found themselves trapped in massive short positions with limited physical supply to cover them. A short position is when you sell something you don't own, betting the price will fall so you can buy it back cheaper later. The risk is theoretically unlimited. If silver is at $20 and you're short, and it rises to $30, you lose $10 per ounce. If it rises to $50, you lose $30 per ounce. If it rises to $100, you face catastrophic losses. For banks holding enormous short positions built over years of manipulation, a major price spike doesn't just mean losses. It means potential insolvency. It means bankruptcy. So price suppression stopped being about profit. It became about survival. Prices had to be kept below a certain level. A kill zone. If silver crosses that level and stays there, some of these institutions face existential risk. This explains the violent, illogical price movements we see today. Silver will rally on strong fundamentals, gaining momentum, and then suddenly crash 10% in minutes with no news. These aren't natural market movements. These are defensive actions. Algorithms slamming the price down to prevent it from reaching dangerous levels. It's not about making money anymore. It's about not going bankrupt. But here's the beautiful irony that the manipulators didn't fully calculate. By artificially suppressing silver prices, they made it incredibly cheap relative to its industrial value and scarcity. Cheap prices increase demand. When silver is undervalued, China buys more for its solar programs. India imports more for jewelry and industrial use. Electronics manufacturers stockpile inventory at bargain prices. Every suppression event accelerates physical depletion. Every price smash drives more metal out of available supply and into hands that won't sell it back. It's a doom loop. The more they push prices down, the faster physical silver disappears from the market. And regulators understand this perfectly. But forcing transparency and honesty would trigger the very crisis they're trying to avoid. So the illusion continues. The paper game goes on. Until one day, inevitably, it won't. Silver cannot be printed. It cannot be created by central banks. It cannot be conjured through monetary policy. When physical supply hits critical levels, when vaults are empty and delivery requests can't be fulfilled, the paper market breaks. Exchanges declare force majeure. Contracts settle in cash instead of metal. Prices on screens become completely detached from physical reality. At that moment, the real price of silver is discovered elsewhere. Between refineries and manufacturers. Between buyers who need the metal to keep factories running. Between those who have it and those who desperately need it. The system resets. And those who understood the game, who accumulated physical metal during the suppression years, who removed their wealth from the paper casino, they win. Some of the smartest investors in the world have been watching this unfold for years. They didn't panic when prices were manipulated downward. They accumulated. They used suppression as opportunity. They understood that artificially low prices created a historic wealth transfer. Wealth was moving from those who sold at manipulated prices to those who bought and held physical metal. This was never just about market manipulation. It was always about a wealth transfer on a scale most people can't comprehend. And every system like this, every scheme built on lies and leverage, ends the same way. Not with justice, not with apologies, but with collapse. The only question is timing. Right now we're in the late stages. Industrial demand continues rising. Physical supply continues falling. The gap between paper price and physical reality continues widening. Smart money has been accumulating. Central banks in countries like China and Russia have been buying. The pressure is building. When the break finally happens, it won't be gradual. It will be sudden. One day, everything will seem normal. The next day, silver will be limit up, trading halted, delivery failures announced. Those holding paper promises will get cash settlements at artificial prices. Those holding physical metal will name their price to buyers who have no choice. The manipulation of silver markets by JPMorgan wasn't an isolated incident. It was a symptom of a much larger disease in the financial system, a system where the biggest players operate by different rules, where fraud is punished with fines that are fractions of the profits, where regulators are captured by the very institutions they're supposed to regulate, where the concept of free markets is mythology, and the reality is managed markets controlled by concentrated power. If you found this investigation valuable, if this opened your eyes to how the system really works, I need you to do 3 things right now. First, hit that like button. It tells YouTube this content matters and helps it reach more people. Second, drop a comment below sharing your thoughts. Are you shocked? Angry? Already aware? Your engagement helps this message spread. Third, share this video. Send it to friends who invest. Post it on social media. Because mainstream media won't cover this story the way it deserves. And most importantly, subscribe to Dark Economy and hit that notification bell. We're building a community of people who refuse to be blind to how money and power really operate. Every week, we expose the hidden mechanics of the financial system that others won't touch. This is information that can protect you, educate you, and potentially change your financial future. The silver manipulation story isn't over. It's still happening. The same dynamics are in play, the same banks are operating, the same algorithms are running, but now you know. You can't unsee what you've learned here. And with that knowledge, you can make better decisions. You can protect yourself. You can position yourself for what's coming. Remember, the system doesn't teach you this. Schools don't explain it. Financial advisors often don't know it. But reality always wins eventually. And when reality finally breaks through the illusion, those who understood what was happening will be on the right side of the greatest wealth transfer of this generation. Stay curious. Stay skeptical. Keep questioning what you're told about markets and money. And keep watching Dark Economy, because we're just getting started exposing how the game is really played. The truth is out there. You just have to be willing to see it.